Folks, welcome to Best Stock Charts for the coming week. Today, we're going to preview a number of stocks where we're going to go into greater detail on during the week ahead commentary, which I'll be sending out to members later on today. And in short, the week ahead commentary breaks down into segments how we plan on trading the market. What's our analysis for where we're going in the coming week? The first part of the analysis is market pulse check, where we review the health of the overall markets. Then we drill down and we take a look at the charts that I'm going to go over in greater detail with members, and we're going to formulate a strategy. How do we plan on trading these markets during the next week or weeks? Now, as I mentioned last week, I don't post as much to social media as I used to because people try to censor what I say. And about 2 minutes, I'm going to go into a tirade about the SEC, and a lot of the social media, they're worried about me bad-mouthing CNBC, the SEC, and every once in a while, they try to censor what I say, and I really don't care. I'm going to speak my mind. So if you want all of my commentary, enter your email address anywhere on the website. We'll get you out all of my commentary so it doesn't get filtered by the social media thought police. So let's begin with Sierra Wireless. This is a recent trade. I closed out this position last week. I spoke about it on Best Stock Charts 2 weeks ago. And I'm going to talk about briefly the profit that we made. But more importantly, I'm going to go into the SEC tick size program that Sierra Wireless is a part of. So bear with me for a moment while we talk about the trade. Then we're going to talk about the new corruption that the SEC is putting forth. They're promoting it. But let's begin with the trade. I spoke about this chart 2 weeks ago. Extreme overbought levels. We had RSI well above 90. I said it was not going to last. We were trading with the share price above the 3 standard deviation Bollinger Band here in green. And on the 13th, we opened a position pretty much near the highs of the day. We pulled back. I could have taken profits. I didn't. We still had RSI at roughly about 87 to 90, and the shares took off once again. I became far more aggressive right here on the 17th, and subsequent to that, the shares fell apart. And as I mentioned on Market Wrap on the 23rd with members, that normally you'll get a 3-day pullback on shares that have extreme overbought conditions. And once we see the 3-day pullback and the RSI resolved, meaning RSI drops down below 80, it's back above it now once again. But when I spoke on Thursday evening, it was at about 79. Now, we got out near the lows of the day because we focused on our discipline. The 3-day rule, we booked profits near the lows of the day. We moved to the sidelines. Now, how did we know when to open up a position in Sierra Wireless? And how did we know when to add to it? Very, very simple. It's a system that I use called the Contrarian Trading System. Become a member. You'll learn all about it. And what we do is use multi-period charts, meaning we don't just use the daily chart. We use weekly charts. Why? The reason is that when you're looking to short a stock, you want to see where there are prior resistance levels, because at those resistance levels, you're going to have people that were sitting with this position from 27, which was resistance level number 1 for us. They sat with the trade all the way down to $9.69. Now they're getting their money back. They've been sitting for well over a year with this position being red. It's finally turning green, and guess what? They don't want to make a profit. They just want their money back. So they sell. So that's what happened. We rallied into resistance level number 1 at 27.07, and we opened up a position. The shares continued to rally through that resistance level up and into 28.60, which was resistance level number 2. We added more and more aggressively. Then the shares fell apart. We booked profits, moved to the sidelines. Why did we do that? The reason is this, is that Strong stocks tend to get stronger. I'm not going to become delusional and believe that Sierra Wireless is just going to fall apart and go to zero. No way. I had a very, very good risk to reward entry point. We had a nice profit. We booked that profit and we moved to the sidelines because the probability, and it's all about probabilities, the probability of Sierra Wireless moving higher is very, very good. Far greater than Sierra Wireless breaking down below key support levels. The money flow, as noted by these volume bars, is flowing into Sierra Wireless, not out of it. So if we want to fight these guys, that's a bad move. So we don't want to fight institutional money. How do I know it's institutional money flowing in? Volume bars. This is not mom and pop buying 100 shares. This is Fidelity. This is Vanguard buying up shares of Sierra Wireless, throwing it in their funds, and they're going to sit with it for a while. Okay, now I'm going to segue into a conversation about the SEC's tick size program, which kicked off back in October of 16. And you might be asking, what does Sierra Wireless have to do with the tick size program? They're part of it. And in advance of my comments regarding the tick size program, I would suggest boycotting trading shares of Sierra Wireless because I did not add to my position in protest because I wanted to add to my position in a penny increment and I couldn't do it. Why? The message I got from my broker was that Sierra Wireless is now a part of the SEC's tick size program. What is that? Basically what it is that you can no longer trade Sierra Wireless and a number of other small cap names in penny increments. You must do it in nickel increments. Think about that. You want to talk about inflation in the stock market? Think about the trading cost of day traders. They just went ripping through the ceiling. Now, I'll grant you, many small cap names don't necessarily trade with a bid ask with a penny spread. Point taken. You don't need to email me and tell me that. I get it. But to dictate from the government in this quote unquote experiment that you must pay a nickel spread on your trade, what will that do to day traders? And what happens when this quote unquote experiment gets expanded to other stocks, which have tighter bid ask spreads than what do many of the small cap names? That is going to be the death knell of the day trader. It's not bad enough, and I'm not a day trader, but I will defend their right to make a living. It's not bad enough that you have algorithms front-running their orders and my orders, but they're impacted to a far greater extent because they have heavier trade volume than what I do by the algos and the front-running that they do, which is basically taking investing and turning it into a game. Now the SEC says, okay, it's not bad enough that we're going to allow front running of your orders, but we're also going to demand that you pay at times 4 cents greater per share than what you might have had to under the 1 cent increment rule. And believe me, you're going to see talking heads on CNBC. They are going to spin the greatest yarn of horse crap that you have ever heard. How they're going to pretend that going to the nickel increment system is going to benefit the small investor. Just like algorithmic trading, it provides far greater liquidity for the small investor. That's how they justify it. Guaranteed. As God made green little apples, that's what they're going to do. So get ready, folks. It appears as though the savings that we realized from going from the decimalization system 15 years ago is now being eradicated. The banks got to the SEC. This so-called experiment is here to stay, guaranteed. The camel's nose is underneath the tent, and it's not going anywhere. So I strongly suggest protest these stocks, boycott them, don't trade them. Let their volume dry up and let their spreads naturally, organically go from nickel spreads to a dime spread. Then they'll change their tune. I digress. Let's go on to best stock charts for the coming week. Let's kick it off with gold. Gold had a great week last week, but it's probably going to come under pressure. Why? It's at the 50-period moving average on a weekly chart, and the gold mining names, NUGT in particular, you're seeing a divergence from the gold minings versus gold. Now, we're going to talk about this on the week ahead commentary. You need to be a member, but we're going to talk about it in greater detail. What does this divergence mean, and how do we play it? And this chart here of spot gold on a weekly basis with an overlay of the gold miners in blue, we're going to look at past divergences, what it meant for gold and the gold mining names. So while I believe that we may see some pressure on gold and the gold miners for the next few days, folks, when you take a look at the dollar, I think that the dollar is going to apply some pressure short term. Longer term, the dollar, hollow candlestick, what does that mean? Longer term, I believe it to be bearish. And we'll discuss this with greater detail with members on the week ahead commentary. Why does this chart matter, the XLU? It matters because weren't rates supposed to go up 3 times this year? If that's the case, then why are the utilities rallying with an inverted head and shoulders setup? And again, this is a monthly chart. This is a big move. Left shoulder, head, right shoulder. It broke out of a 45-degree neckline. Why are the utilities moving higher when yields are supposed to be heading higher as well? Because they trade inversely. Everybody knows that. But when you take a look at yields, yields are dropping. They broke down last week. Why? And we'll discuss why this is good for gold longer term. Shorter term, gold is probably going to come under pressure along with the miners. LABU we're watching for the coming week. We bounced off the lower band of support last week. We'll talk about strategy, about entering this position. We've been waiting for a pullback. I think our opportunity is close. I'll be sending out an alert if and when we do open up a position on LABU. Members, we're going to take a look at the intraday charts of LABU to see how our risk to reward entry point is setting up. APPl, an extreme overbought trade. It's sitting at current with 86.08. It pulled back on Thursday only to flash a bullish key reversal on Friday. Now, when this occurs, when we hit an all-time high, then we pull back, the question then becomes, do we break out or do we break down? The test is always at the top. That's what I always teach members. Now, with RSI at 86.08 on a Dow stock, this is not going to last. This extreme overbought condition on RSI will get resolved. We'll talk about our trade strategy on the week ahead commentary. Take note of ADX, well above 60. APPl, despite this bullish key reversal on Friday, is going down. It will not be here 2 weeks from now. Now, just because I'm so adamant that this rally will not last on APPl does not mean I'm jumping with both feet on Monday morning. We will leg into our position, perhaps not Monday morning, but in the next several days. Cisco. All right, very long term, I am very, very bullish on Cisco. Short term, it's overbought. It can move higher, but it's going to pull back. We have RSI on a big S&P name at 85.75. It's not going to stay there. Volume to the upside dropping off. So Cisco is setting up as a short-term short. Longer term, I think it's going a lot higher. Why do I say that? Monthly chart. Again, we always take a look at the monthly charts, weekly charts, sometimes quarterly charts, daily charts, intraday charts, because we want to see where a stock has been to identify where it will probably head moving forward. And the monthly chart, you could see that we had a breakout above 3250. Now, is this chart in and of itself, the monthly chart of Cisco, the reason why I am so long-term bullish on Cisco? No way. The chart I'm looking at, ask your broker the last time he looked at a quarterly chart, or your investment advisor, a quarterly chart, you could see that we are breaking out on a quarterly basis above resistance that's gone back years, back to the dot-com bust. We are breaking out of it now. Now, would I go running in tomorrow and buying Cisco Systems? No way. I began the conversation by saying it was a short. What do I think is going to happen here? Fairly simple. I'm going to go back to the monthly chart. Remember this chart while I'm talking about the monthly chart. We have a breakout above resistance. Now back to that monthly chart. Okay, so back in July of 2016, we broke out of a very, very long-term resistance level. Again, it went back years. We broke out. But we didn't do that much after that. We traded sideways for several months, and then we broke back down. And we retested the breakout point. Not only on price, but we did it on RSI, meaning we broke out. Traders are OCD, folks. They want to come back down and retest to make sure that what was resistance is now support. And on both RSI and on price, Cisco passed the test. And you should expect to see the same thing on a quarterly chart. So while I'm bullish longer term on Cisco, it can most certainly pull back. And then on that pullback, a healthy pullback too, on that pullback, we'll look to get longer term. That'll be a position trade, not a short-term swing trade. More to come in the coming months on Cisco. Amazon. I spoke about this chart while we were trading in this trading range back in early February. And I said one of two things. It's either going to break out of this triangle formation, it's going to rally up to prior resistance, or it's going to break down. So if it rallied, we would possibly buy the shares. Some of my members did. I did not. If it broke down, we would look to short the shares. Now, Amazon last week, it broke as we hit resistance, and it flashed what I like to call, let me update this chart. I'll be right back so I can illustrate it better. It flashed a breakout point failure, or as some call it, a bull trap, meaning it broke out above historical support on February the 21st. Only 3 days later, it broke back down below that support level. Extremely bearish stuff. I cannot put it into words how bearish that is. And when you take a look at the indicators, you have RSI, which has been putting in a lower high despite the fact we've been breaking out to higher highs. That's a divergence. Take a look at volume. Creeping up sequentially, still at about average, but rising sequentially. Ultimate oscillator, left shoulder, head, right shoulder. Here's the neckline. Check out your MACD. Lower high, possibly going to go negative very early next week. Amazon is a potential short. Members will talk about that trade more on the week ahead commentary coming out later today. Moodys, daily chart. All right, so RSI is at 85.65, folks. This is a publishing company. It's not supposed to have RSI 85.65. On Friday, it looks like the shorts got squeezed, as noted by the light volume. We're probably going to get another move higher and then a reversal, and I think that Moodys is setting up for a nice short. FireEye, weekly chart. This is a very bearish chart, folks, and I own it. I have not added to my position. I've wanted to see whether or not we would get a healthy breakout. We failed last week. I think we're coming back down to this lower band of support. So what we're going to talk about today on the week ahead commentary with members is how do we manage this position? How do we know when to stop out? Or how do we know when to add more to the position? So members, more to come. But this weekly chart is very, very concerning. Note the volume. Rising down volume above average. So while I'm not saying go in Monday morning and sell your shares, I am saying caution flag is on the track. Have a strategy if you're long of FireEye. The triple Qs, I think the triple Qs are either at a high, they've seen a high, or they are extremely close to a top. And what is reinforcing my opinion about the triple Qs is the doji star formation last week. It's a sign of indecision. Also, take note of the volume. Volume during this last run up, which began in June of 2016, take a look at the volume. While you've had a few weekly spikes higher of above average volume, for the most part, the trend is down. So we're at all-time highs with PE ratios very extended. And now we're flashing a doji star formation on the triple Qs. We are focusing on building short positions using the QID. And this is what we're going to be talking about today. How do we short the market? Building a position in the QID. And you may be saying, Bob, Jesus, Mary, and Joseph, the weekly chart of QID is horrible. What are you talking about? What are you doing here? There's no hope. Well, I beg to differ. The charts are telling us that we're beginning to see some strength in the QID, some accumulation. Take a look at the price action on RSI. RSI was this time last week well below 20, now back above it, but only slightly. When you take a look at the price action last week, you flashed a doji star formation on a daily chart. For me, that is clue number one that the end is near. It doesn't mean to buy it. It just means to watch it very, very carefully. Sure enough, traders began selling. They took it down below the lower band of the declining downtrend channel, so it flashed a bear trap. Traders sold. What did they do? They got burned. It rallied on the 23rd. It broke out above this upper band of resistance. This is a buy signal. I don't mean go jumping in with both feet, opening up your position. What the market just gave you was an indication that you have buyers below, willing to support the shares at 19.66. Now, the beautiful part about this is that you know exactly where to set your stop. Risk management. This is what the QID is offering you right now when you're taking a look back to the triple Qs weekly chart at a chart of the triple Qs flashing a doji star formation, rallying ad nauseum on volume that is significantly below average. Caution, folks. Members, more to come on the week ahead commentary. Next chart up is GLNG. The last time I spoke about GLNG was, believe, on my 2017 stock market forecast. And it was one of my long picks. And at that point in time, we were within a triangle formation. We have since broken out of the triangle formation. And you could see that last month, January, we closed off the highs of the month. This month, we have broken out, but are trading well off the highs of the month. This is a bullish chart to me, but guess what? I think GLNG is going lower. I don't think that's a bad thing. I think it's a good thing. All you need to do is go back to my earlier analysis on Cisco Systems, because what I think is going to happen here is we're going to pull back, retest the breakout point, because traders are OCD. They want to make sure that before they put their nickel down and go buying shares, they want to make sure that this prior resistance level, a very, very long-term resistance level, will now act as support. If and when it does, that's the green light. Go jumping in. So members will talk strategy about GLNG. And that's it for this week, folks. If you're not currently a member, please sign up for the 14-day free trial offer. Again, I don't post as much as I used to on social media because of controversial comments that aren't appreciated. So sign up for my newsletter and you'll never miss a commentary. And all you need to do, enter your email address on anywhere on the website. You'll get added to the free newsletter list for best stock charts and any other commentary that I might make. And we have a no spam pledge. You will not be spammed. I hate spam too. And remember, boycott the SEC's tick size program. Voice your opinion. Members, stay tuned for the week ahead commentary.